What's up, guys? It's Brian here with Ride Your Money Wave. I came across an article online that says that the average American scored an F on this investing quiz. They only got 4 out of 10 questions correct. And so, being the teacher that I am, especially someone who enjoys personal finance, I thought that I would take the quiz and see how I did. So, I encourage you to take it along here with me and see how you do as well. So I haven't looked at this yet. This is the first time that I'm taking this quiz, and I thought it'd be fun to do it. So let's take a look and see how we do. So question number 1, which best describes your understanding of compound interest? Well, compound interest is the interest that you earn on top of interest. So I know what compound interest is, and I know how to calculate it. I know what compound interest is, but I'm not sure how it's calculated. That might be a little bit more accurate. I know that it's like P1 plus N raised to the RT, something like that. But if I were to be 100% honest, I would say that I'm not sure how it's calculated. So that's going to be me. Okay. What's the S&P 500? It is an index that tracks the 500 largest companies of the United States. That's an easy one. True or false? When you purchase a stock, that means you are partial owner of a company. I'm going to say true on that because you get to share in the profits. That is correct. What is a dividend? That is money, profits that are paid back to the shareholder. We are doing good so far. All right. How is a company's share price determined? The Federal Reserve? No. Board of Directors? No. The stock exchange? No. Supply and demand in the market. Boy, I hope we're good on all these. And that is correct as well. Dow Jones, it's only 30 companies. And very few of them are actually still part of the original Dow Jones when it came out years and years ago. All right. True or false? Novice investors should focus on timing the market to maximize their investments. That is a big fat false. Do not try to time the market. Okay. What matters most is time in the market, not timing the market. Go back and take a look at the stock market in March and April of this year. Okay, no one really saw that coming. It was a very V-shaped stock market. And so, trying to time that, if you sold, you've missed your opportunity really to buy back in. You can't predict the big swings, so you just got to buy and hold for the long term. And there's a video that I did earlier that talks all about what happens if you miss the best 5 days in the stock market, the best 10 days. Spoiler alert, your returns dramatically decrease. So don't try to time the market because you have to be right twice, when to sell and when to get back in. And it's next to impossible to do. So buckle up, get ready for your financial roller coaster. And there's going to be some great days when it goes up. And there's going to be some terrible days when it goes down. But don't try to time the market. And that is correct. Good. What does it mean when the stock has a high PE ratio? All right. This is cool because it's like getting harder, right? PE stands for price to earnings. And earnings are really your profits. And so this is the price that you pay in order to receive $1 worth of profit. So do you want to pay a high price to receive $1, or do you want to pay a low price to receive $1? Well, I'm going to pay a lower price to receive $1 of profit. So we want a lower PE ratio. And when you hear people talk about whether things are overvalued or undervalued, what we're really looking at is the PE ratio relative to the PE ratio of the S&P 500, because it generally reverts back to the mean. If you can buy the S&P 500 for let's say a historic PE ratio of like 16, but you find a stock that has a PE ratio of 10, then that stock is undervalued, and people should be realizing that, buying it, and it drives the PE back up to the average. And so if it has a high PE ratio, I would say that the stock is expected to decrease in value because it would be overvalued. This is one of those numbers where the bigger is not better. You want a low PE ratio. Son of a gun. It says I'm incorrect. If the stock's PE ratio is high, that usually means that it's highly valued by investors who are willing to pay a higher price today based on expectations of future growth. A high PE can also mean that the stock is overvalued. That's what I'm talking about. If the PE ratio is low, it's selling at a relatively cheap price. This is debatable. Okay, we're going to put a little asterisk next to this. So I'd say I got like 1.5 wrong. I don't know off the top of my head the equation for compound interest, and a high PE ratio normally means that it's overvalued. This is ticking me off. Okay, 2 more to go. How long do you have to hold a stock for it to be considered a long-term investment for tax purposes? I'm guessing that they mean capital gains, and I believe it's 1 year. Perfect. Once you hold on to a stock for 366 days, your capital gains rate drops down to 15% instead of either the marginal tax rate or I think it's 20%. So if you're buying a stock in a brokerage account, make sure that you're okay with it for 1 year if you want to get that tax break. Do all stocks pay dividends to investors? Answer, no. Amazon does not pay a dividend last time I checked. But normally a dividend is a sign that it's a very healthy company because they have so much capital, they have so much cash and profit that rather than reinvest it back into the business, they pay it out to you on a quarterly basis. So the average American got 4 out of 10 right. I would debate that 8 out of 10. I think it's more like 8.5 maybe, or even 9 because of that problem dealing with PE ratios. But there you have it. A quick, easy, and hopefully fun little education lesson about personal finance. The best part about personal finance is that once you learn it, it stays with you. And it's scalable. You can use this when you're just starting off with $1,000 of investment, and you can use it when you have $1 million in the bank invested. And it's so important to learn even just the basics of personal finance because it is the ladder that is going to help you, dig out of a hole and come to the land of milk and honey. So till next time, use this information in your life, implement it, develop a good relationship with money, and remember to go out there and go live your best life. Take care.